The biggest threat to your retirement is not the volatility of the stock market. It's the hidden fees inside of your 401k. Let me show you. So this is a 401k plan from somebody that I've helped allocate their 401k. I have their permission to show it. So I'm going to show it. I'm not going to show you the name, but I'm going to show it. Right here is the mixture of all the investments. And at the bottom, you can see there's a total of $308,000 in here. And there's 25,000 in the Vanguard Index Fund institutional shares, $229,000 in their version of the S&P 500. This is the 500 index. And then there's a target date fund of $5,000. And I left that in there because it was the default that she originally had in there. And I wanted to show her, let's just keep a small percentage of that so you could see the performance of each one. And so I'm going to get into it. So when you click each fund name, it brings it up. So this is the target date fund. And what this does is it's 2050. So this person, based on their age, is going to retire in the decade of 2050. So the fund manager scales back the investments. It'll be heavily weighted in stocks with a little bit of bonds. And as they get older, it'll go to more conservative bond type of investments inside of there automatically. This is something's better than nothing. So if you don't want any responsibility, this is at least better than to have than nothing. But in this, you can see here where the thing to look for is right here on the fund facts. So it's like as I said, it's balanced right here, stocks and bonds. It is expected retirement in the decade of 2050. This is right here is where the fees come in, the expense ratio. So this is 0.035% of a charge. So this is a fee that you're never going to cut a check for, that the Vanguard will automatically take this money out. It's a cost of doing business with them, right? And that doesn't seem like much, right? Because you're like 0.035%. That is, let's just call it 1/3 of a percent. So you're like, that's not that much money. And when you look at other fees in other funds, we'll pull up an index fund. This is the S&P 500 fund that Vanguard has, the institutional 500 index. Now we look at it here. It is a large blend of the 500 biggest companies like S&P 500. The expense ratio is 0.0105%. So this is 1/10 of a percent. So believe it or not, that savings from a third of a percent to this 1/10 of a percent, that savings in fees or less fees will make you hundreds of thousands of dollars over your career. So although you're not thinking that it's that much money to have 1/3 of a percent, which is that target date fund, or 1/10 of a percent, doesn't sound like much, but that extra money going into 30, 40 years of your career into the fund itself instead of a fee is literally hundreds of thousands of dollars. This other index fund over here, same thing. This is 0.04%, right? That's the expense ratio inside of this index fund. So just being aware of these funds is very, very important for the growth of your portfolio. Now, when I come back over here to look at the overviews, we could look at, say, the performance, right? So the performance of this fund right here, the 2050 fund, 1 year is 14.9%, 3 years 16.12%. Let's look in comparison to the S&P 500 fund. Remember, this is right here, 14.9 for 1 year and 16.2. The S&P 500 fund, when we come to price and performance, right here, is 1 year is 15.87 and 19.52. So it essentially is, let's get the exact number, 15%, 1% more on the 1 year. And on the 3 year, it is 3% higher. So you make 3% more money on the index fund and have a much lower fee. So not only is the index a higher return, but it is a lower cost. And you look at the inception of this fund in the index started in 2017. The return is 14.7% annualized return. When you look at the target date fund, it hasn't been around that long, but it is 11.7%. So you can see the other one has been around since 2017, 3 years sooner, and has an average of 14.9%. This one hasn't been around that long. It has 11.7. So really the index is exponential. It's 3% higher in a longer amount of time, which is harder to do because a higher return per year over a longer time, it takes much more growth to have that happen. So in the index fund, you're making 3% more per year with a much lower fee. So this is another reason of why you have to really understand your 401k in order to make money. And what I initially said is you could be losing hundreds of thousands of dollars in your retirement account by just not being aware of fees. And again, the target date fund, something's better than nothing, right? But this is just an example of why you want to be aware of it. When we go back over here to the main page, some other things to be aware about are how much money it grows, right? And so let's look at this right here. So now I just hit the performance, okay? And this person started over here, and here's their account, okay? They started at zero, which it says right here, starting balance is zero. They put in $144,000 and their account is $308,000. So you can see here on this chart where in 2017, when they started working here, it just starts slow contributions. And the purple is money coming in, okay? And the orange is money coming out, which there's no money coming out here because they set it, forget, and put money in. The dark blue is the current balance. So you could see 2017, right? Money's going in, right? You're not really seeing growth. You're not really seeing growth. Money's going in because there's volatility, right? But then right here, a year later, you start seeing the blue start creeping up where you start making money on your money. Markets being bad, and that's why you don't see the blue anymore, is because there's volatility here. And now if people look at this 2 years later and be like, I put money in for 2 years and I don't really have growth. And then look at this dip right here in 2020. This is COVID, where the market, all of the growth was just wiped away. Okay. And then you have more transactions, which is the purple, more money coming in, and still not doing that well. Right. And this is in 2020, this is 3 years later. And you're like, you have less money in there than you initially put in. And that would discourage a lot of people, right? But this goes back to, you have to set it and forget it. And you still see here the purple, money's coming in, and you can see that consistent growth, right? Because this is per paycheck. Every single paycheck, money's coming in. But now look at this. After the COVID bounce back, now look at the growth. Out of nowhere, the money just started growing, the dark blue, right? It's like, okay, now I'm making money on my money. In the purple, you see it here, still coming up. But then look what happens right here in 2022. There was a big market decline. The S&P 500 finished negative that year. It was about a negative 18%. So right here, you barely now have a little bit more money than the money that went in. And so this could be very discouraging for people, right? Like, I was just up here with all my money at 132,000. And now down here, I'm down to 118,000. So I lost, 25 grand. Like, what is going on? And on this, on the 118,000, remember, $110,000 of this is this person's money. And that's what you can see right here on this chart, is in this little white box. Starting balance was zero. Net transactions is how much money has gone in, 110,000. Investment gains is $8,000. So they put in 110 grand and have only made 8 grand of this. So it could be discouraging, but they stood the course. Then they started getting higher, right? Like, okay, I put in $132,000. Now my investment gains is 40 grand. So now there's 40 grand made. You're like, okay, I'm making money. My current balance is 172. I'm riding high. This is nice. I put in 132 grand. I have $40,000 of gains. Then look what happens right here. This huge drop off, 2023, boom, market went down. Now they have a total of $29,000 of gains. Now coming up over here, stay the course. A little bit of money, less money went in during this time. Keeps going in. Market drops again right here. This is Liberation Day over here, right? Market drop. Now we're right here. So at the end of it, it's a total of $142,000 in and $114,000 of gains. But you can see here, just based on the visuals, now we're down here with money in and we're up here on money growth. So this test of time is proven here. The longer you stay in it, the more money you make. And this person's been working here for about 9 years now. And we're at that point now where the investment growth is not going to drop down below from the money in. And over the next 25 years of work, this is just going to grow exponentially. So you could see here all of this growth, right? Here's performance details. We'll scroll down. In 2017, $11,000 made. 2018, 17. 2019, 8 grand. 2020, 39 grand. 2021, 55,000 made. In 2022, when the market finished negative 18%, it was a loss that year of $1,700 loss. 2023, $6,494. In 2024, 118 grand made. Right? Like, look at that, right? It's right here. This is how you look at it. And you can see that there's always going to be ups and downs. But when you continuously put your money in, you're going to be able to see exponential growth the longer you stay in it. The biggest mistakes that amateurs make that don't understand this is that they don't properly allocate their money. And this is exactly what you want to do, is look at, okay, how can I get the most return with the least amount of fee? And the target date fund, again, something's better than nothing. If you just put money in, it'll be there, it'll be fine, it'll be invested. It's something's better than nothing. And this right here shows you in this asset allocation, look at this. 91% of money is in stocks. 8.27% is in bonds. So this is more conservative. So you're not getting as high as the growth because money is in bonds. Whereas you look at the other fund, which is the index fund, the S&P 500 index. If you look at right here, the, where is it? The portfolio right here is that you can see, where's that? Let me scroll down to the asset mix. Oops. Overview. This right here, they try to scare you, right? The risk is at 4. It's potentially risky. The performance returns is, here's a good one right here, where it shows, here's the fund. The blue is the Vanguard index and the yellow is the S&P 500. And you can see they're right neck and neck, right? They're right there in the neck and neck because they invest in the same type of funds. But when you look at the portfolio management of this one, there is a total of $3.7 billion in this fund. So all of your money, $3.7 billion, whoever's invested in this fund gets the same investments. And this is where you have to really understand indexing is so important. And there's billions and billions and billions and trillions of dollars in these indexes. And it's just one of the most beautiful things for your retirement is to really, really start putting money into higher return, lower fees. And this is just an example I wanted to show everybody what to really navigate and look for inside of these funds. Is because if you don't understand it, you could be thinking you're making money and say in the target date fund 11%. But if you just switched over, you'd be making 14% per year through the index fund. And not only will you make more money, but in the index fund, you have that 1/10 of 1% management fee. In the target date fund, you have that 1/3 of 1%. So this is what people talk about when you hear, oh, there's fees that could be killing your gains. This is what they're talking about. Even though it's seems like a small amount of a number of fee, it will cost you hundreds of thousands of dollars that would have been in your value, in your account, in your balance, if you had your money allocated differently. And so this is just one example of what you need to look for and how it works out when you're doing your fund, when you're doing your 401k. And there's tons of things that you could look for, right? This is one example I wanted to show you was how this performance works, and just put money in. Just like the S&P 500, it's always going to be up and down. And don't get discouraged. Just stay in it to win it. Your future self will thank your current self with how much money you put inside of this because you took care of yourself. And you can see here one more time, the purple is money in, the blue is the account value. And as the longer you put in, the more account value total you have in growth of the money in. In the beginning, you're sometimes, because of the market volatility, you're going to be seeing, I'm not really making that much money. I'm not making that much money. But over time, you will make money. And you'll get to the point where this blue totally eclipses the purple, like 3, 4, 5, 6x times of that. This person here hasn't even been putting in for 10 years. Started in 2017, it's 2025 right now. So keep that in mind. You got to stay in it to win it. You will benefit from this. But like all things, when the market takes dips, so does your account. But the longer you have and the more money you put in, the more growth you're going to have like this. So this is one little tutorial I wanted to give on understanding fees of your 401k and the impact that they could have.